Ever seen those dramatic movie scenes with traders panicking and numbers flashing red? That's a stock market crash, and it feels like a distant Wall Street problem, right? But what if I told you that what happens there can ripple out and affect your daily life, your job, and even the price of your groceries? It sounds scary, I know, but understanding it is the first step to not fearing it. So, let's break down what a stock market crash really means for you and me. And stick around, because I promise there's a silver lining to all of this that you won't want to miss. So, what exactly is a stock market crash? Imagine a huge bustling marketplace where, instead of fruits and vegetables, people are buying and selling tiny pieces of companies called stocks. The price of these stocks goes up and down based on how well people think those companies will do. Now, a stock market crash is when, suddenly, everyone gets scared at once. Maybe there's bad economic news, a global crisis, or just widespread panic. A wave of selling starts, and everyone tries to get rid of their stocks at the same time. This massive sell-off causes prices to drop fast and hard. Think of it like a sudden, widespread loss of confidence that sends asset prices into a nosedive. It's not just a bad day at the market, it's a significant, rapid decline that shakes the entire financial system. So, how does this Wall Street drama spill over into the Main Street economy, where most of us live and work? Well, the stock market is often seen as a barometer for the health of the economy. When it crashes, it's like a giant warning sign flashing recession ahead. Companies, big and small, start getting nervous. The value of their own company on paper has just plummeted, and they see consumer confidence dropping. This makes them hesitant to spend money. They might delay big projects, cancel plans for a new factory, or halt research and development. This corporate belt-tightening means less money is being invested back into the economy. Businesses stop expanding, which leads to fewer orders for their suppliers. And the slowdown begins to spread like a chain reaction, affecting industries far beyond the financial sector. This slowdown directly impacts the job market. When companies stop expanding and start cutting costs to weather the storm, one of the first things they look at is their payroll. This can lead to hiring freezes, meaning fewer job opportunities for those looking for work or wanting to switch careers. In more severe cases, it leads to layoffs, as companies downsize to stay afloat. Suddenly, job security becomes a major concern for everyone, even in seemingly stable industries. The ripple effect continues. If people lose their jobs or fear losing them, they spend less money, which further hurts businesses, creating a difficult cycle that can be tough to break. It's how a financial event can quickly become a personal employment crisis for many. Now let's talk about something incredibly personal: your savings and retirement funds. Many of us have our long-term savings, like a 401k or a pension plan, invested in the stock market. That's how these funds grow over time. When the market crashes, the value of these investments can take a significant hit. You might log into your retirement account and see a number that's much lower than it was a month ago. It's a gut-wrenching feeling. For those nearing retirement, it's especially terrifying, as they have less time to recover those losses. Even for younger people, seeing decades of savings seemingly evaporate overnight is deeply unsettling and can make the dream of a comfortable retirement feel suddenly out of reach. On top of everything else, you might notice your daily expenses start to creep up. This is another frustrating side effect. A market crash can affect global supply chains and the value of currency. This can make imported goods, from the gas in your car to the electronics you buy, more expensive. Companies, already facing financial pressure, might also pass their increased costs onto consumers to protect their profit margins. This means you could end up paying more for groceries, utilities, and everyday necessities. So, not only are people worried about their jobs and savings, but their paycheck doesn't stretch as far as it used to. This squeeze on household budgets is where a stock market crash really hits home for everyone. Okay, we've talked about a lot of tough stuff. Job worries, shrinking savings, rising costs. It's enough to make anyone anxious. But now, let's talk about the part you've been waiting for: the silver lining. It's crucial to remember that historically, every single market crash has been followed by a recovery, and these downturns can actually create incredible opportunities. Think of it as a massive sale on the stock market. For investors with a long-term mindset, a crash is a chance to buy into great, solid companies at a huge discount. It's like being able to buy a fantastic house for half its price, because the neighborhood is temporarily unpopular. This is the principle that has built fortunes. Legendary investors like Warren Buffett famously say to be greedy when others are fearful, when panic is high and prices are low. That's the moment to strategically invest, not to run for the hills. If you're younger, you have decades for the market to recover and grow, and buying during a downturn can supercharge your long-term returns. For everyone, a crash serves as a powerful lesson in financial resilience. It encourages us to reevaluate our spending, build up our emergency funds, and diversify our investments so we're better prepared for the future. It's a stressful, but ultimately valuable, financial fire drill for all of us. So, while the headlines about a stock market crash are always scary, remember that it's a part of a larger economic cycle. It affects our jobs, savings, and cost of living in very real ways, but it's not the end of the story. Understanding the why and how strips away the fear and replaces it with knowledge. And with knowledge comes power. The power to see the opportunity within the crisis, to stay calm when others panic, and to make smart decisions for your financial future. The market always recovers, and those who stay the course are the ones who benefit in the long run. Thank you so much for watching and taking the time to understand these complex ideas with me. If you found this helpful and a little less scary, please give this video a thumbs up and hit that subscribe button. It really helps the channel, and we'd love to have you in our community. Stay safe, stay informed, and I'll see you in the next video.